Mark joins us from Pittsburgh. Good to have you on with us, Mark. So in anticipation of Friday, boy, volatility still the name of the game. But, markets started off on an optimistic note, but then it trailed off towards the end. What do you think of markets right now?
Susan, I don't know why the markets were up as much as they were to begin with, so I wasn't shocked to see them end relatively flattish. It was really no news, other than perhaps some buying coming in the absence of the pressure of selling that we've seen occur over the last 4 weeks. All in, I think things are going to remain fairly volatile, even though we have some economic reports that might provide some positive or possibly even negative data points to accumulate in advance of Friday's speech from Ben Bernanke from Jackson Hole. Everything including the Richmond Federal Manufacturing Survey to housing start activity to initial jobless claims. So, we're not going to be in a complete void of information between now and then, but, clearly all the focus is going to be on Friday's presentation and what, if anything, Ben Bernanke is going to allow for people to look over the wall to the insights as to what the next move might be from the Fed to help to shore up economic activity here in the United States.
Yeah, from what I'm hearing from analysts and fund managers, they keep saying it's 50-50 they'll get QE3. But correct me if I'm wrong, the sentiment of the last few sessions prevailing seems to be that we will be getting QE3. There's going to be a huge disappointment if we don't get, in fact, the words that we're looking for from the Fed chairman.
I agree with you totally. In fact, I think it's dangerous to presume that we are going to hear anything definitive. I think it would be very uncharacteristic to expect the Fed chairman to announce out of the Federal Open Market Committee meeting a policy initiative of any sort. I think clearly he'll review the playbook in terms of what the Fed's options are to be able to signal to the markets that they're still full of arrows in the proverbial quiver to cure current circumstances if need be, including the most flexible option of all, which is the actual launch of QE3, but I hardly expect to see anything along those fronts come out on Friday, and so to the extent the market would be bid up in advance of that with that expectation in mind, I think we'd be subject to disappointment.
Yeah, Mark, can you be a little specific here in terms of what exactly you expect to hear from Ben Bernanke? Of course, there's going to be a lot of translations of Bernanke speak, but what are you expecting?
Well, I'm expecting for him to review things like the ability to swap maturities inside the Fed's portfolio. So the net is no increase to the Fed's balance sheet, but they could swap shorter-term maturities for longer in an effort to level out the yield curve, particularly if they were to be buyers of mortgage-backed securities in lieu of treasuries, which would help out the housing market and create an enhancement for continued refinancing activity and to allow for home mortgage rates to stay low to accommodate potential buyers. Perhaps talk about tools like lowering the reserve payment that they offer for banks that keep money parked with the Fed. Obviously, as well, they could talk about the flexible option of going back and actually being buyers of additional securities to balloon their balance sheet beyond what it is today. And there's probably even the unconventional option that I don't expect them to talk about, which is to basically finance the Treasury, to actually have the Treasury Department go out and support asset values through the purchase of equities, which would be pretty aggressive and probably more a situation of last resort.
You said, Mark, that equity valuations are compelling should a recession be averted. Is that going to happen? Can the U.S. avert recession?
I think it can avert the recession. I mean, right now, all the data points are not indicative of a recession. I mean, perilously close, unfortunately, which is why David Rosenberg and others have assigned such a high probability to a recession, because the margin of safety at the moment is so narrow, it wouldn't take much of an exogenous event for us to see a contraction in economic activity. But, right now, the inertia is such that we're seeing kind of 1% economic growth. It's anemic by all measures, but nonetheless, we're expecting to see some continual improvement on payrolls. Initial jobless claims numbers are indicative of modest payroll growth, and as a consequence, that should help to feed into a self-sustaining economic growth pattern that is lackluster but positive nonetheless.